Hello and welcome to Your Next Move with Luann Jones.
And
And
Erica
thank you
Berry.
for the introduction. I
Go for
appreciate
it,
it.
Erica. Start us off.
Yes, so real estate decisions, as we like to say, are some of the biggest decisions you ever are going to make in your life. So why not have expert advice and opinion from two people who have been in the industry? And I'm Erica Berry.
And I'm Luann Jones.
I'm right here in North Carolina, and
And
you're
I'm
in New
in
Jersey.
northern New Jersey.
Northern New Jersey. Today we're going to talk about first time homebuyers, how you get ready, and what's the difference between being pre qualified and pre approved. It makes a difference, it's not the
Big,
same.
big difference.
So, Luann, do you come across a lot of first time homebuyers in New Jersey?
Yes, a lot. A lot of people coming from like New York. Um, they're first time home buyers. And there's many of them. And they're like my favorite people.
I like them too. I love it's like real cuddly conversations and they really want to know everything and they're bright-eyed, bushy-tailed. They want to get into their first property. A lot of people in up north have been renting for a long time because it's just very cost prohibitive to buy in that area. Here we have first-time home buyers. You have a little bit easier way to get in, but I think the anxiety is still the same when you're getting ready to make your first purchase. So
Yeah, I mean it's the largest purchase of their lives. So there's a lot of anxiety, going over that.
and the one thing about being anxious is your finances. Are you ready? Is your credit up to par? Like, are they going to be digging in on you and finding out, like the FBI, all the things about you? I
Yeah,
mean,
I
lenders can be a
mean,
little rough.
well, it is quite a detailed journey, and there's a lot of factors that these buyers are not aware of, and sometimes the lenders don't even bring it to their attention because there's so many moving parts. You know,
I find
like
that.
yeah, like
Go ahead.
their income and for the time being of their going through the home purchase process with the lending. There's a lot of guidelines, and they have to make sure that they're not spending unnecessary money, not depositing, too much into their account that they can't account for. I had a situation where we were getting ready to close, and the my client's brother didn't have like a checking account, so he thought, hey, let me give you $3,000 and write me out a check. So that prevented us from closing on time because that money had to be accounted for, and they were not aware that that was going to affect their closing date.
Speaking of people writing you checks, a lot of times people who are first time home buyers have family members that will gift them money. And you
Right.
have to account for that. There's a lot of fraud surrounding that kind of transaction. Even I learned from a continuing education that a lot of times when people work for their family, you have to prove, you have to have your pay stubs. It has to be legit because sometimes people fake things. They can fake pay stubs. They can fake a whole bunch of stuff. So
Well, you do have to answer a questionnaire stating that all the information you've given them has been the truth. So hopefully, you don't, you know, veer off from that rule.
yeah, I mean, of course. So when you're a first time home buyer and you're getting ready, people want to pull your credit a lot. And the one thing I've learned nowadays is that a lot of lenders can do what they call a soft pull. And it doesn't affect, a lot of times, it doesn't affect your credit rating because a hard pull can reduce your credit by anywhere from 10 points to 15 points, I hear. And that could be
Give or
detrimental if
take.
somebody's on the borderline for getting a better rate. And when we talk about rates, that's the interest rate. And depending on where your credit falls, under or over a certain minute, you can qualify for a lower interest rate or better deals. And it
Well, the
also
higher the credit, the better the interest rate, and
right.
vice versa.
And then the one thing I learned recently is that you no longer need an FHA to only do 3% down. You can do commercial. Was it commercial loans? Oh, was it
No,
FHA,
commercial loans are
not
25%
commercial.
down
I meant
payment.
commercial loans. What? It's FHA. It's what's the other one? VA.
Conventional?
Conventional. I was messing up. I'm messing up, girl.
It's
Conventional loans
okay.
have you can do 3% on conventional loan, and actually it's better if you have credit that's pretty good because you're not charged all those fees that FHA will charge. And so
Right.
that's what I
And
learned the
there,
other day.
yeah, there's special programs too that you could put 3% down. They pay for some closing costs and no mortgage insurance, which is extremely helpful.
Yeah. There's also special programs for people who are like medical professionals. VA has
Firemen,
no money down kind of situations.
yeah, well, yeah. VA is no money down. They have for teachers, firemen, policemen, nurses, doctors. But the doctors, they don't really need the programs because the guidelines don't apply to them.
Yeah, but they do get a better interest rate.
Special, yeah, special interest rate.
That's good. And also, I found that my nurse that I'm helping right now, if you ask, sometimes new home construction will give you a credit. Like we got one nursing, was it special helpers, $1,000 closing credit, like silly stuff like that. It's like
Right.
it's not silly. It's actually nice. It's
Every
good to
little
ask
bit
though.
helps.
And then also for her, she could qualify depending on if you want to. Now, this is a tricky situation too. Something we can talk about is the down payment assistance programs that they have.
Right.
Do you guys have that in New Jersey?
Yes, we do. We do. They have to qualify, obviously, but they do have special programs where they'll apply. Actually, how it's done on some of the programs, where if you use their title insurance company, they'll give you a credit toward closing costs for like $3,700 or $4,000.
And some builders, if you use their lender and their title, then you get a whole bunch of stuff towards closing costs. But that's usually newer construction, right?
Yeah, yeah, it's newer construction. They offer their own special rate or whatever. Um, they have their lenders and they have their own guidelines. It's different from the government programs.
Yeah. I find that sometimes the down payment assistance program, it has a limit on how long you have to stay in the house before you have to pay it back. If you don't stay in the house, like for instance, like 2 or 3 years, then you have to kind of pay it back. But it could not matter if you have enough equity built up, and it still helped you get into the house in the first place. So
Yeah,
just
some of the
something to watch out
programs
for.
here, I did one down in South Jersey where we closed on a townhouse, and my client is a teacher, and they applied for the program, and basically they have to live in the house for 5 years. They can't sell it. So if they sell it before 5 years, they have to pay that program back.
Yeah.
But after
So those are
five
those are
years,
little
they
things.
get to keep it.
Those are little things you got to watch out for. So it depends on your plans. And if the area is known to have increase in equity, then you're good.
But
Like,
yeah,
I mean, I would say houses will generally appreciate or have more equity, about 2%, 1 to 2%, definitely,
yeah,
depending
that's
on the
that's a
area.
basic. Yeah, that's a basic timeline rate.
I
With
mean, some
the
places like we had some houses. Somebody's talking about some people bought houses in a certain area for 700,000 during COVID, and now they're worth close to 2 million. That's crazy, but
it is
you
crazy,
know,
but it does happen.
it happens. So basically, pre-qualification versus pre-approval. What's the main difference?
Okay, so prequal is something that you're just verbally saying. So when you speak with your, lender, mortgage rep, however you want to say it, basically, they'll be telling them how much they're making, what their debt is, if they have any, if they are renting, if they're leasing a car, if they're, so they'll take whatever they're saying on how much they make a year and what their bills are and whatnot. And on that information, they will give them a pre-qualified, which that's a very basic, and not many sellers are really liking those pre-qualified letters.
No, no. When you go to a seller, you got, I'm pre-qualified.
Yeah, well, that's no bragging
Yeah.
rights, I can tell you that.
I mean, yeah, okay. When you are pre-approved, you have gotten everything checked out. You've run a hard pull. You've done a hard pull on your credit.
Right, the
They
hard
can actually
pull.
see your debts. They could see your income and all the
Your
things
debt
that
to income ratio,
your debt to
your
income ratio is very
yeah, your
important.
credit score, which is really important.
Yep. And sometimes it's just good to know that what your credit score is, because if you are a first-time home buyer and you want to get a better rate, there's certain little things you can do, like paying off certain credit cards or paying off certain that can bump your credit up. The one thing I found out about for my college kid is sometimes people don't report. Like she has a credit history, supposed to have a credit history from paying rent on time, but sometimes they won't report it. You can go and self-report and have them self-report that for you to raise your credit up a little bit. So a lot of people who are retiring, they say, "Oh, we don't have any credit cards," which is not a good thing because if you have no credit,
No,
it's
no credit is as bad as having bad credit.
yeah. So you got to have some credit and you got to show that you can pay it off. And the
Right, you
crazy
have
thing
to
is
establish a paying pattern. You have
a
to
paying
establish.
pattern,
Yeah,
and multiple paying patterns increases your credit score. Some people will transfer a balance to one card and only have one payment, which actually could lower their credit score, which I found out. Did you know
right.
that? It's
Yeah,
better to have little parts and pay all of them, and actually increases your score. I was like, really? That's crazy. And the other thing about entrepreneurs who are first time home buyers, you're trying to prove that you have assets and you have income. Well, entrepreneurs like to write everything off.
true.
So they base everything off your net. And if your
Yeah,
net is small because you have taken a whole bunch of deductions, it's hard to have
right. Like
deductions.
that, it's typical with a 1099 person that, files taxes where, like if you're making like $100,000, but you have all these write-offs, and then in the end, if you are only showing like 30,000, well, that's what they're going to base you on.
Yeah.
And then there's a pro and a con to that,
Yeah.
because you will be paying taxes on 30,000. So, but if you want to get approved that you're making 100, and you have to do less deductions, but then you're going to be paying taxes on 100,000, not 30,000. So,
As an entrepreneur, I know they really go all in on you, and you need both people. If your spouse has bad credit and you don't, sometimes they could just go make the loan in one person's name so you get a better rate, and then you can add them on later.
because they go with the lower credit score.
Yeah. So sometimes that's something you want to consider when you have two people in a relationship. Anyway, I think we've gotten a lot of good information today about
I think
first-time
so.
homebuyers. I mean, if you guys think you need more information, you have some questions, definitely like, subscribe, and share, and come join our podcast. This is your next move, and we're trying to
Move.
prepare you,
Yep.
Luann and Erica, and we are trying to get you right and ready for it. So
For
if you
your
have any
next purchase.
if you have some specific questions that you need, you can always message us and we can try and address it the next time. And or if you have any questions about this episode, definitely come back. But we are signing out from North Carolina.
And Northern New Jersey.
See you soon.
See you next time.